Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're keeping incredibly well, that you had a wonderful, wonderful Easter break. What a treat to have sunshine all over a bank holiday weekend. So lovely. Now look, what have we got for you this week? So we've got our usual lender update. We're going to run through some pricing enhancements, or changes probably is a better description actually, and also some criteria, definitely enhancements there. And then what I'm going to do is just run through what estate agents are reporting they're seeing in terms of the housing market, and just discuss a little bit about how that's going to shake out and impact the property market going forwards. Okay, so first up with our lender changes this week, we've seen some changes to pricing from Metro Bank. So what they've done is actually quite interestingly, they've reduced their 80% loan to value products down by 24 basis points. These now start from 3.05%, coming down from 3.29. Conversely, they have increased their 70 and 75% loan to value products, and these have increased and now start from 2.29%. There's an increase there of up to 10 basis points. Now look, in terms of Metro Bank as a lender and where they sit in the market, so we don't talk about them very often, not because we don't like them, we just don't come across them in terms of newsworthy articles very often. But they're a really good lender. Now they used to, back in the day, have a really good offering for limited company lending, which they then stepped away from. So they've been busy going about their day, lending to individual landlords, and they've been doing it on a fairly subdued basis. But more recently, they've really come to the fore as quite a keen lender, and there's really two reasons for that. So first of all, their pricing is actually quite good. But also, I think the thing that really stands out with these guys is their rental calculations, so how much you can borrow per pound of rental income. So when we're sourcing mortgages, we have a really neat piece of software where we put in some key headline numbers, so property value, loan amount, rental income. And what our system does for us is the maths in terms of telling us whether a deal is available to a client based on those three metrics. And Metro Bank for personal borrowing actually seem to come out as being one of the more generous lenders at the moment in terms of their calculation that they're using. So on 5-year fixed rates, what they're saying is that their calculation is 140% coverage, assuming an interest rate of 3.5%, which is actually one of the most generous on the market. So they're a lender who kind of, whether by luck or design, is actually becoming increasingly popular at the moment. So what else can I tell you about Metro Bank? So first of all, beyond their very good rental calculation and their very good pricing, on remortgages there are incentives. So some of their products have free valuation and free legals. They tend to operate on a flat arrangement fees. So their products either have a 995 arrangement fee or a 1995 arrangement fee, which again, works out for some people and not for others. It just depends on the maths involved. Now, like I say, they're only lending to individuals. They need the individuals to have no more than 10 buy-to-let properties in the background. Now, they operate what they call a no minimum income requirements. They don't mind how much you earn, but you have to be earning something. And the key here is that it cannot solely be from rental income. So if you're a landlord where you have rental income coming in, but you also have even a fairly lowly paid day job, that's absolutely fine. They would accept you. But if you're earning loads and loads of money as a landlord but have no other sources of income, then Metro Bank are not going to be the right lender for you. Other things to note, they can accept mortgages where the term goes up to age 85. They can consider longer by exception, but 85 is kind of their normal stopping point, which is fairly in line with the rest of the market. They can accept consumer buy-to-lets, so that's where a property is being remortgaged, which was not acquired with the sole purpose of renting it out. So generally this would fit into renting out your home and buying someplace else to live in, or when you've inherited a property. These are two kind of key consumer buy-to-let areas. Loads of lenders do consumer buy-to-lets, but not all of them, which is why I flagged this. And Metro will also do let to buys fitting in with that, which again, not all lenders do. So that's where you're putting a buy-to-let mortgage on your current home and you're going to be buying a new property in which you're going to be living in. And again, I say, most lenders will offer this kind of transaction, but not all of them. Now, other things to consider with Metro Bank, they can consider flats over commercial, they can consider ex-local authority properties. And one of the things that we've used them for quite a few times in the past is they're good on those properties with shorter leases. So 50 years is their kind of starting point actually, so that can work really, really well for those kinds of properties. Okay, now Accord Mortgages have made a change to their rental calculation that they use, and this applies for those landlords who are remortgaging on a like-for-like basis. So what that means is that they're just replacing the existing mortgage with a mortgage with Accord, and they're not raising any additional money. Now, the rental calculation that Accord would generally use for a basic rate taxpayer is 125% coverage, assuming an interest rate of 5.5%. If you're a higher rate taxpayer, it's 145% at 5.5%. But what they're now doing is saying that actually, if you're doing a straight switch to a like-for-like remortgage, they will drop the calculation down to 125 at 4.5%, or even 140% at 4.5%, or even 5%, depending on the calculations. There's lots of different permutations here, but the key point being that if you're doing a like-for-like remortgage, Accord mortgages are able to lend you more money than they would have done previously. Okay, now this is quite an interesting thing, and we talk about rental calculations often, and I think it's worth just touching on again because they're not a straightforward thing. So lenders will use different rental calculations depending on many factors. So the key ones being is this personal or limited company. So limited company would enjoy a rental calculation of 125% coverage as standard. For personal borrowing, it's 145% coverage. However, for some lenders, if you're doing a personal remortgage, they will then apply a different rental calculation away from the 145% if you're a basic rate taxpayer, so it comes back to 125% coverage. And then what lenders can do is give you a more generous rental calculation if you're taking a 5-year fixed rate as well. And the reason lenders are able to do so is the expectation is that if you take a 5-year fixed rate, you're going to be shielded for that period of time across interest rate fluctuations, obviously very topical at the moment, but also over 5 years your rental income should actually steadily increase as well, which means that when you get to the end of the 5 years, even if interest rates have gone up, your rental income would have gone up as well, and it would be able to kind of absorb any additional mortgage interest costs. So that's why lenders are able to kind of flex different types of calculations depending on lots of different permutations. And the other one that comes into play is this like-for-like basis. So if, using your sort of common sense approach, I suppose, if a borrower has a mortgage with a lender, which they are servicing perfectly well, and by remortgaging to you as a new lender, the actual cost to the borrower of the mortgage interest is going to come down, but nothing else materially changes for the borrower, why on earth would you not be looking to take that debt on? They're managing on a higher interest rate, so obviously they should be able to manage on a lower interest rate, and that's why lenders are able to offer, or some lenders choose to offer, a slightly more flexible calculation here. So what I think from Accord is really commendable. It's great to always see lenders challenging themselves and their lending criteria to try and make things look a lot better. And as I've mentioned in previous weeks, as the market really starts to cool down and the lenders aren't awash with business in the way that they have been over the last few months, we will expect to see more and more changes of this type as lenders reach into their toolkit and try and figure out which tweaks they can make to their lending criteria to really kind of drive up business volumes. Okay, so a few other rate changes for you now. So we've seen MOLO increase rates across their individual and limited company 2- and 5-year fixed rates. So rates now start from 3.8%. They've also increased rates across their HMO 2- and 5-year fixed rates, with rates here now starting from 4.05%. So MOLO as a lender, so they're a relatively new lender into the market. I do really like them. They're very much a lender who is relying on technology to try and disrupt the experience of applying for a mortgage and make it much more streamlined and kind of quick and more pleasant for the borrower, essentially. Have they done this? Yes, their technical solution is really, really good. Do we love them as a lender? The jury's out at the moment, if I'm brutally honest. Actually, the experience of keying the application and the kind of technological side of things is really, really good. But with all of these things, at some point, there's still a person that picks up the application. I don't think there are many lenders, if any, where things literally slide straight through and a person doesn't touch the application once. And what we find with MOLO is at this point, things tend to go a little bit wonky at times. Not always, but at times. So actually, really, really commendable lender. Great that the kind of idea is there. And we do need the mortgage industry to be disrupted. It's quite archaic in terms of some of the process that are involved. They haven't exactly nailed it just yet, I would say, but really, really good. So look, MOLO, so some not bad pricing. Obviously, it's gone up. Limited company and individual borrowing, a couple of other bits of criteria which are quite nichey, so you can have no more than 20 buy-to-let properties in the background. Now this was actually much lower. They've recently increased it, which is really fantastic. You do need to be earning £20,000 a year worth of income to access a mortgage with MOLO, and maximum age on maturity of the loan is 96 years old. Don't ask me why it's 96 and not 95. It just is 96. But look, so, in terms of MOLO as a lender, like I say, we're not overly in love with them at the moment. That might change, as I think, because they're a new lender, every new lender comes to the market and they do have teething problems. I think the intention is there, and actually their pricing is not bad at all. Now, we've also seen rate increases from Landbay. They have increased their rates by between 0.05% and 0.29%. So their pricing now starts from 2.99. We've also seen platform home loans increase rates this week by between 19 basis points and 23 basis points. Now, one of the things landlords have been reporting to us when they're looking to invest at the moment is that while they have the absolute desire to invest in properties, there's actually not a huge amount to buy. So not a lot of stock on the market. And actually we've seen this reported in terms of the estate agents as well. So it was interesting to read that in March, 8% of respondents to a report reported a rise in the volume of fresh listings coming onto the sales market. Now, what they've said is that, interestingly, new buyer inquiries also rose that month too, with an increase of 9%. Which is the first time that actually since the pandemic began that the number of new properties coming to the market and the number of new buyer inquiries have been so closely aligned. So things are actually starting to kind of come more closely together. So that's a really, really positive thing, particularly the sight of new properties coming to the market increasing, because that's really what's keeping things, keeping the house prices so high at the moment, the lack of stock available. Now, what the report went on to say is that the moderate rise in housing market activity seems respondents anticipating the same for the near term. So looking to the next 3 months, sales expectations remain positive, with 16% of contributors expecting a rise. Looking to this point next year, sales volumes look broadly stable, with 2% expecting an increase. So what we're essentially seeing here is that people are expecting things to stay on a relatively even keel, albeit on an upwards trajectory over the coming months. Now, this is the bit that I think was probably most interesting, actually, that I wanted to share with you. So looking ahead, respondents expect house prices to rise further in the coming 3 or 12 months. Looking over the next 5 years, contributors to the survey expect house prices increase by around 4% per annum. Now, this report is then dovetailed by a commentary with the RICS chief economist, and what he was saying is that essentially, despite the mounting concerns about the macro environment and the war in Ukraine, for now, feedback from RICS is showing that the housing market is remaining resilient. The rising interest rates have started to push up the cost of mortgage financing, but debt servicing remains low in a historic context, which helps to explain why the new buyer inquiry indicators remain in positive territory. So really just further underpinning the expectations that while the housing market is really expecting to slow down comparatively to last year when we had the stamp duty holiday, actually house prices are very much looking to increase over the coming 5 years. And that is me for this week. Thank you, as always, for joining me. I hope you found that helpful. I really, really do hope to be able to come to you next week or the week after with some news about, really a new, really low interest rate being released or something like that. But for now, I'm afraid it's one direction of travel. We've had the ONS data released today, which has shown that consumer spending in some sectors has actually come down, which may give us a stay of execution on the Bank of England review early next month. But I suspect that won't be the case, unfortunately. So we are expecting still a base rate increase to happen, despite the data revealed in the ONS report today. So look, if you have any questions, please do give us a call, 0345 345 6788. Have a look at our website, Mortgages for Business. We've got lots and lots of really wonderful information on there. Until then, it's just left for me to wish you a wonderful weekend, and I will catch you at the same time next week.